All right, everyone, welcome back. I'm your host, Stephen Norris, and as always, my co-host, Michael Dye. And today we're talking about what is a debt-to-income ratio. Now, this is a term that you hear a lot if you're looking to buy your property from the lender point of view. So obviously, this is Michael's realm, but to give you guys a quick little definition of what debt-to-income ratio is, or your DTI ratio, it is very simply a formula that is your monthly income divided by your monthly revolving debts. Now, obviously, we're going to talk about what exactly a revolving debt is, or I should say Michael will talk about that. But basically, this is the formula that lenders use to qualify you for a house. Because remember, when it comes to your monthly mortgage, there's more than just meets the eye. There's something out there called your PITI, or principal, interest, taxes, and then also you have your interest too. So that being said, it's a giant picture we have to look at because everyone thinks, oh, my mortgage is $2,000. That's all done and done. That's not the case sometimes. The mortgage includes what is the actual principal of your loan, the interest if you have some, which we'll talk about too, property taxes, and then your home insurance. We all have to have insurance for certain things, right? And then, of course, things in addition to that could potentially be things like if I have an HOA, or a very one that pops up recently is that if you have a solar panel lease on your roof. Some people do, some people don't. We'll get into that a little bit too, but the point is that not everything meets the eye. Every lender looks at everything differently in terms of how they calculate it, percentages and stuff like that. So that's the brief overview of exactly what it is we're talking about there. But Michael, take it away for the folks with exactly how lenders use the DTI ratio to help qualify folks.
Right. I mean, you've got it kind of right there. The DTI is definitely one of the metrics that we use in the mortgage industry to use to measure an individual's ability to manage monthly debt and to repay their debt. So your debt to income ratio is a percentage that tells us lenders how much money you spend versus how much you have coming into your household. You can calculate your debt to income ratio, or your DTI, by adding up your monthly minimum debt payments and then dividing it by your monthly pre-tax or gross income. Okay, is really what we're looking for here, because we always are going to be using your gross income before taxes. When you're applying for a mortgage, we're going to go ahead and probably max that DTI requirement out for you on your debt and what we can do with that. Lenders prefer borrowers we prefer borrowers obviously with a lower debt to income ratio than a higher. And there's two different types of debt to income. We have your front end ratio, which is really only including your household related expenses. This is calculated by using your future monthly mortgage payment and then including your property taxes and homeowners insurance. And that's your front end. Your back end is going to consist of that mortgage payment, as well as all your liabilities that you have: student debt, credit card debt, any kind of debt that you have that has a required minimum monthly payment on there. And that's what we're going to see on there. And, on certain loans and certain programs that we use, we can definitely push that up a little bit. But we really want your DTI ratio. I mean, if a great DTI ratio is right around 36% or below 40, if you will. However, we are able to go ahead and push some of those things, as we can see through our automated underwriting system, our AUS, will kind of allow us to know that. However, saying that right now, beginning in July 1st of this month, Fannie Mae and Freddie Mac has tightened up those DTI ratios and your AUS a little bit because of our lower interest rates, and we want to make sure that the borrower is not going to default on their loan down the road. So that's really how we use your debt to income ratio, is really seeing what the ability that you have is to pay back the debt that you are starting to acquire.
That's awesome. And guys, that's the best explanation that we can kind of give to you, because again, every single lender is different. They're going to calculate you differently, and they're going to be able to help you with that differently too. Now, remember, another key thing Michael said was that it comes down to your net income on a monthly basis. So whatever you file your taxes with, if you're W-2 or if you're 1099 self-employed, make sure that whoever you are doing your taxes with, they know your future endeavors, because guess what? If they are writing too many things off and trying to buy a house next year, you've hurt yourself, haven't you? So if you're thinking about buying a house, doesn't matter if it's in the next month, the next 6 months, the next year, the next 5 years, please reach out to myself or Michael so we can start game planning with you for the future. All right, that's what it's all about, is building the education, the resources to get yourself into a better position today to help you guys acquire and achieve the goals that you want to set for yourself down the road. That's what it all comes down to, all right? Now, I know this is a topic that we can talk about forever. So for more information about this, please reach out to us, and we'll see you guys all next time.
See you later.